Good afternoon slash evening, and you have reached the website for the presentation of the AAII National Income and Cash Flow Special Interest Group SIG Group presentation today for Thursday, April 17th, and hosted by the Portland, Oregon PDX chapter. And this is Todd Blickenstaff, the president and program coordinator for that chapter, as well as for this special interest SIG group meeting. And I'm joined here by our able webmaster, John Wong, and also Gilbert Ho, who will be doing a presentation initially and doing his normal monthly overview of the economy and the financial markets. And then we're going to, after we do Q&A for that presentation, we're going to turn the microphone over to Jay Hatfield. And very excited to have him here. I'll give an intro to, about Jay a little bit after. And we want to recommend everyone that please feel free to ask any questions using the Q&A icon at the bottom of the screen, and not the chat icon, but the Q&A icon, because we can do a better job of monitoring the questions and answers and with the webinar format that we're using for Zoom here this evening. I'd like to thank everybody for attending this evening. And I know we've got beautiful weather out there, so it's a bit of a distraction. And we normally, as we are doing here, we normally do our meetings on the third Thursday of each month, beginning at 4 p.m. Pacific Coast time. And normally our target date, our time is about 90 minutes, so we'd finish up at 5:30 our time. Well, sometimes we run over if there's other Q&A that we want to spend time on to give everyone a chance to ask questions. And so at this point in time, I'm going to turn the microphone over to Gilbert Ho from the Silicon Valley AAI chapter, and to do his monthly presentation on the economy and the financial markets. So, Gilbert, you've got the microphone and as well as the screen, so take it away.
Okay, thanks, Todd. We have professionals doing presentations today, so I'm the amateur, and I'll just quickly go over my 10 slides. The disclaimer, as usual, these are at most educational and most likely entertainment. So don't take it too seriously. So we started with interest rate. And the first thing is looking at a 10-year rate versus 3 months rate. And looks like the purple line, the yield curve is flirting with inversion again, which used to predict recession. The next one is looking at the 2-year Treasury versus the Fed fund rate. And the message here is the market thinks monetary condition is tight. In other words, Fed fund rate is higher than the 2-year. Then look at the interest rate at various maturities from 1 month to 30-year. This is Treasury. And the red line is current. And compared to a year ago, which is the blue line, we can see that short-term rate, as driven by the monetary policy, has come down. Fed had been cutting rate, although they're on hold right now. And the loan rate actually went up, and this is a hot topic recently. Usually that reflects inflation expectation and deficit condition. So going up is not a good thing. Finally, the quantitative tightening, Fed started that in September 2022. And they just slowed it down a little bit more. And so right now, I think they got rid of a quarter of the balance sheet. Looking at 10-year Treasury, this has, like I said, have been a topic. And if you're a chartist, you'll look at that that rectangle and you say, okay, it's in a trading range. And I just found interesting that the Treasury Secretary is saying their goal is to lower the 10-year. So we shall see. US dollar, if you notice on the right-hand side, there's a sharp drop. And here's a long history and what's happening. But the latest expectation is because the tariff usually favor the currency. However, we have a reverse of that. And interestingly, if you look at the gold performance versus the dollar, that's quite a contrast. So, this is a mystery, I guess, as to only time will tell what does this mean. Finally, looking at commodity futures, we just picked 6 examples here, starting with the gasoline. This 12 months chart shows that gasoline is a little bit on the uptrend. Natural gas, because the winter weather has been high. Copper is going up. So corn went up and then corrected. And live cattle, which is the steak, is on the high end. Also lumber, which is surprising because I don't think we're building a lot of new houses. Finally, looking at the inflation data, there's a producer price index, which the message is, I guess, where everybody is waiting for the impact of tariffs. And same thing on the CPI and PCE index, although they're floating around, I guess, same thing, we're waiting for the impact. The interesting thing is the University of Michigan's inflation expectation has been spiking up recently. And if you look at the multiple decades long history of this comparing with CPI, this is pretty good indication of what CPI is heading. And finally, this is a supply chain index where Fed was counting on to say, they used this to say inflation was transitory a few years ago. Finally, and then, not finally, then we look at the job opening, the labor market, and job opening is still in good shape. All these detailed data tells us that, one, the openings are more than unemployed workers. And if you look at the green and red, which is hires versus separations, and they're coming down. So we're not looking at the hot labor market anymore. And the quits rate is also normalizing. So these are going back to the normal numbers.
Yeah. Gilbert, didn't I see an article recently? I might have been in the journal that talked about how the differential between salaries with existing employees are receiving and then the compensation that they get when they are successful in moving to a different firm has narrowed dramatically. So that's probably a factor in shrinking that quick rate as people come around to that realization, if it is indeed accurate.
I think that's probably part of the reason. And why is this opening and data is important is during the inflation time, the job market is driving the inflation, and when having these numbers coming down to normal level helps cool the inflation. That I think that's a message here.
Mm-hmm.
Okay, so looking at another employment side of data, you can see that it's obvious trend that the monthly increase of employee people are trending back down. Looking at unemployment rate, looking at the labor participation rate, they are all back to normal. Well, unemployment rate actually, even at 4.2, I think is still historically low. And I take the average hourly earning times the average weekly hours and do the annual rate of change and compare that with the CPI, which is the red. We can see that the income level are still healthy. They're above the CPI. Looking at today's initial claim, we are still at the historical low level. If you look at the long range, and here we only show recent. Finally, I'm in Silicon Valley, so this is the Silicon Valley unemployment rate, local unemployment rate, and we're about the same as the national average. So all that high tech layoff is still the economy is still healthy here. Finally, looking at the ISM data, the manufacturing index is below 50, which means contraction. And the service part of the PMI is heading to 50 line, which is contraction. And this, excuse me, this is the data that Paul mentioned in one of his press conference, and I'm just continue to look at it. And finally, the shocker here is the GDP now from Atlantic Fed, which showed a negative GDP growth. That if we get 2 quarters of that, then we're in a recession. Finally, the last slide is looking at the leading economic indicators. They didn't work in 2022, and they have this warning signals, and now we're in this warning period. So I guess the message here is we are teetering on the edge of recession if things don't turn positive soon. That's all I have. Thanks, Todd.
Yeah, thank you, Gilbert. If anyone has any questions, again, I want to remind people it's optimal to type any questions that you have during any part of our presentation tonight in the Q&A section, and so those questions can be responded to at some point during any of the presentations. And and please use that rather than the chat feature because it's more user friendly in terms of us compiling and screening any questions that you may have. And I would like to ask at this point if since there aren't any questions yet in the chat in the Q&A section for tonight, if anyone has any questions so far about anything that Gilbert has presented, and you can take yourself off mute and speak verbally too if there are. And what we're going to do is, and we can circle back later on. And one of the things, what I'm going to do now is we're going to transition to our main featured speaker for this evening. And that is Jay Hatfield, who's CEO of Infrastructure Capital Advisors and is the lead portfolio manager of the Infrastructure Capital Bond Income ETF, also the InfraCap Small Cap Income Fund, InfraCap Equity Income Fund, InfraCap MLP, U.S. Preferred Stock, InfraCap REIT Preferreds, and as well as some private funds that they manage. And Jay will be presenting on the market and outlook for 2025 for the balance of the year in this volatile year, as well as where he and his firm see fixed income opportunities and also suggested risk management strategies given the volatile environment that we're having. Jay has extensive experience in the investment business. Frequently, you'll see him on CNBC and Fox Business. I have, as well as Barron's, the Wall Street Journal, Yahoo Finance, TD Ameritrade, and also Bloomberg Radio, TV. And also each month, Infrastructure Capital hosts a monthly economic webinar where you can sign up to attend by visiting their website, which we'll share. We'll put that in the chat room actually, in www.infracapfunds.com, and those are well worth attending. And I had the good fortune to meet Jay at a Las Vegas investment conference recently. In fact, I got to hear 2 of his presentations, and actually talked with him and when he was manning Infrastructure Capital's booth at one point in between speaking engagements. And and I'll just our speaker here, we definitely gave some of the best presentations I've heard by any speaker there. So we're very, very excited to have Jay with us this evening. And Jay, I wanted to ask you, I forgot to ask you in the rehearsal portion, would you, for any questions that come in, would you like to take them? Would you like me to monitor them and um, give them to you during the presentation, or would you like to take questions after your presentation?
Why don't we try to make it more interesting and do it real time? So if a question comes in, I'll try to address it,
Okay,
or I will address it.
okay.
That makes it more interesting, I think, so it's more interactive.
Right. I think that's great. And so what we can do now is we'll turn over the podium and the screen to Jay. And I think it looks like we've got your presentation loaded and ready to go. And I'd like to thank Craig Starr, who also worked with Infrastructure Capital and was able to facilitate arranging to have Jay address our group tonight. So thank you, Craig, as well. And Jay, the podium is yours.
Great. Thanks, Todd. Thanks for the introduction. So we're excited to make this presentation. We love talking to clients and potential clients. We also like to provide solid educational material. My background is I'm from Northern California. I have a degree in economics, managerial economics from UC Davis, a CPA from Ernst & Young in San Francisco, an MBA in finance with distinction at Wharton. And I've worked on Wall Street for 36 years. About half of that time as an investment banker doing utilities, MLPs, and energy. And the rest of the time on the buy side, I started out at two large hedge funds, Simmer Lucas Partners and 72 Point, run by Steve Cohen, the owner of the Mets. And in both roles, researched and traded fixed income and equity income. And that's what our firm does now. I launched this Infrastructure Capital 2008. The first project we worked on was taking an MLP public. My friend Mike Krimble runs that. It's NGO Energy Partners. We have a hedge fund we launched in 2012. Our MLP fund, AMZA, in 2014. And then we launched the rest of the 5 funds we have since then. So that's my background.
Great.
In terms of our firm, we are focused on long-term investing. I was at a conference recently, and somebody was talking about technicals and call strategies and momentum. And that's fine if you want to work full-time on your portfolio and be basically an amateur hedge fund manager, but not what we would recommend most people do. So we look for companies, infrastructure focused, that have a lot of time, not always, but long-term assets like utilities, pipelines, MLPs, REITs, so that if you want to generate income, it's reliable, there's assets backing it up. If there's any issues, they can sell assets. And all of our funds provide substantial income from 7 to 10%. And we do think, we'll get into it later, it does make sense to focus on income. It's an easy way. It's both a quality screen, so low quality companies usually don't pay dividends. Higher quality companies do. And it also reduces the volatility of your portfolio. And it also, if it's substantial enough, the income allows you to mostly, it's impossible to mostly ignore the mark to market. Because if you're getting a lot of cash flow that covers most of your expenses, or at least a good portion, then you don't have to worry about having to liquidate to pay your bills when the market's really depressed, like now, for instance. And then the other thing that we do that I would, if you do investing on stocks, I would recommend doing this or outsource it to people like us. But we have a very defined process. We look for reasonably priced companies in quantitative screens. And then we, if they're promising, then analyze the companies, build a model, talk to the company, talk to the sell side. And then we come up, if it's attractively priced and there's high quality company with some catalysts, we'll add it to the portfolio. And then we monitor it just to make sure that it doesn't become overvalued. If it runs up a lot and earnings haven't gone up, we'll sell it. So we have this very defined process. We have something we call the comps or comparables. So we're constantly analyzing how companies stack up relative to the market as a whole and whether they're attractive. And doing that type of work is important. You avoid blowing up if you do that. So like we look, we follow Tesla a little bit. We're mostly just are short it occasionally, but it's trading at over 400 after President Trump got elected. I think it was trading at 150 times earnings. Where our models would say it should be like 30 times earnings or 40. So maybe you have Tesla, maybe they will cure cancer and have robots and taxis, but you're taking a lot of risk when you buy something at 150 times earnings above their growth rate and focused on a lot of things that may or may not happen in our opinion. So we're going to focus today on fixed income strategies. We have an equity income presentation as well, but we're not going to cover all that today. We'll touch on it briefly. So these are our three funds, and we have a slide and coming up that provides not just our funds, but every category of fixed income that you can possibly invest in. And what we recommend for almost everyone, really everyone, is have a bond allocation. It can be, if you're young, it'd be 10%. If you're older, it could be 50, 60%. Have an equity allocation. And then within the fixed income sector, you should have a lot of different asset classes, which we'll talk about. The two of them, the ones that have higher income and more correlation to the stock market, less correlation to the bond market, is BNDS. That's a high yield bond fund, yields just over 8% on a distribution yield basis. PFFA is our flagship fund, 1.4 billion, top performing fund, yields well over 9. PFFR is an index fund. We run low leverage with PFFA, approximately 20%, no leverage with PFFR. And it's an index fund, but with some smart beta. It sells preferreds when they're above par and have negative yield to calls. So we'll get into a little bit more of that detail about that. So, and then this slide is all of our equity income portfolio. So again, say you're 50% debt or fixed income, 50% equities. These would be potential inclusions in that 50%. And of course, we recommend being diversified. So have, say, 5 to 10 funds on the income, on the equity side, 5 to 10 on the bond side. And so SCAP, small cap fund, yields about 7. We write some small amount of index calls to generate extra income. We also own some preferreds, run low leverage, 15 to 20%. And this fund you'll find is less volatile and actually is substantially outperformed, but check that on our website, get the real data. The broad Russell 2000. And we think the secret sauce there is finding these reasonably valued companies, high quality, no money losing companies. At least 20% of the Russell 2000 companies are losing money. And if you just take one thing away from this call, is do not invest in money losing companies. If you want to become a venture capitalist, then go do that. And you can find all kinds of money losing companies and can be on the board and figure out how to make them make money. But when I was an investment banker, it's not true anymore. It's more or less true, but we wouldn't take companies public that weren't profitable. It's just too risky. Odds are stacked against you. So SCAP's all profitable, all with dividend yields, all low leverage, high quality companies. And like I said, it's less volatile and has better returns than the index so far. ICAP is large cap equities, household names, but we add a ton of value there by writing individual calls on large cap companies, weekly calls at prices where we have a gain and where we're prepared to sell it. So we don't mechanically write calls like some index funds do, which we don't think is a good policy. AMZAs, MLPs, it's in the form of a corporation, 1099. And actually, MLPs are really well positioned right now because they are transporting natural gas. And that's a very important fuel. It's the critical fuel for incremental electricity generation, for AI and other uses. It's also the key export fuel. So unappreciated opportunity there. Not going to talk a lot about these funds. If you do have questions, you can follow up with Craig and talk more about the equity funds, but this is a fixed income presentation. And you can see here from this chart, these are the SEC yields. A lot of times distribution yield, well, it depends on the timing, but it can be a little bit above or below this. And I'm going to talk about macro, which might seem repetitive with the prior presentation, but we really focus on forecasting. So rather than just
Jay,
focus
would you mind if I just pause you for a second, and we have a question in the Q&A before you transition to macro, and one attendee was asking if you have any funds in the closed-end fund space that you manage.
It's a great question, and we'd love to have that because it's kind of like the Roach Motel of investment management. Because you can check in, but you can never check out. But we don't, because there really haven't been any IPOs of those companies in years. And really ETFs have dominated because they traded NAV. And so you don't get the situation where the asset class goes down and the discount goes up. And so in bad markets, closed-end funds can be kind of dangerous because you get sort of double whacked. Whereas ETFs trade right on top of NAV almost all the time. That's a great question. But if you have any we should acquire, let us know because that's a great business and love to be in that business for the manager. Not necessarily as good for the investor, but so we have a unique view, and these are all forecasts, like I said, so it's not repetitive. But we believe that we're in stag deflation. So obviously that's a little bit tongue-in-cheek because everybody's saying we're in stagflation. But stagflation only really occurred once, and that's in the 70s. And what was going on there is we had wage and price controls. So their US production plummeted. So the market price of oil was up to $40, and US producers are getting paid like $5. So our production plummeted. World price kept going up because nobody's responding with supply. OPEC was holding back on supply. And so you had this 1,200% increase in oil prices, which bled through to core and also detracted from consumer spending, hurt economic growth. So it's really skyrocketing oil prices in the face of terrible economic policy, namely price controls that cause stagflation. Otherwise, it doesn't happen. The reason we call it stag deflation, so right now, we're forecasting the PCE comes in at 0.1 at the end of the month, and it rolls down to 2.5. Now the Fed is forecasting 0.1 more than that, but still, even if they're right, they're coming out at 0.2 and 2.6. Well, if you take that number and correct for the lagged shelter component, shelter is miscalculated. uses a 2-year lagged index to estimate shelter costs, which is 40% of CPI. If you correct PC for that, it's below the Fed's target, about 1.9. CPI is about 1.6. So inflation, even if it doesn't feel like it, because we had during the Biden years, Powell overinflated the money supply, and we had 22% inflation in 5 years, which is a ton. But that's not, it's hard to get that back. So, you know, rents are going to be 22% higher. Hamburgers probably 22% higher. Probably not going to reverse, but inflation is every year. And so year over year is very tame. And the big debate, and I was on Fox Business today, because there's a lot of discussions about firing Powell, which we think might be slightly disruptive, but is the right call because he doesn't understand monetary economics. He's a politician. And so what he doesn't understand is, even though it's maybe painful for the consumer, but tariffs should be treated as a sales tax, which is deflationary. It takes consumer spending away as a one-time, not transitory, but one-time increase in the price, which is painful. And every consumer calls that inflation. But economists don't include one-time increases in prices, particularly when they come from taxes. Taxes hurt consumer spending, slow economic growth, and create deflation. So that's kind of the debate going on in the Fed. The Fed chair, as usual, is on the wrong side of the debate. Governor Waller does understand this dynamic. We'll see it in the data, though. You get a couple of quarters of high CPI, and then, but energy is off 15% from the beginning of the year. That'll feed through as well, be somewhat of an offset. And then after those couple of months of high inflation, you'll see we'll go back down to 0.2, 0.1, 0.3. And so even the Fed should be able to figure out that that was a one-time increase. So we're bullish on inflation. We're bullish on bonds. We're roughly 430 on the 10-year right now. We think that's going to drop to a 3.50 to 4% range. So midpoint 3.75. So we're bullish on bonds, and we'll talk about the stock market. We do think the Fed's going to be forced to cut 3 times, even though they don't know that yet. But we're also, we were more pessimistic about growth about 2 months ago, and then everybody got super pessimistic about growth, and now we're more optimistic than them. We tend to be pretty consistent in our views, and the market's gyrating all over the place, which is not a good way to manage your outlook. But the reason for that is the Fed is very tight. Their Fed funds is about 150 basis points too high right now. Should be about 2 3/4. It's 3 1/4, 3 3/8. And so that's slowing. Normally that would create a recession because housing would crater. We have a shortage of housing, so housing's hanging in there. We have something called the Hatfield rule, which is similar to the Psalm rule, that if housing starts to go below 1.1 million, you're going to have a recession. 11 out of 12 recessions were caused by a crack in the housing market. By the way, consumer spending's never caused a recession because consumers consume. They're like woodchucks who chuck wood. They just consume. Low-end consumers have to spend money. High-end consumers want to spend money and will continue to spend. So, and also tech spending is really strong, which is offsetting slowing both housing and construction, commercial construction. We are actually, this slide's a little bit out of date, so I apologize for that, but we were neutral on the market before we got into earnings season. Now we're in earnings season. We think that's going to stabilize the market, which it has been, even though it doesn't quite seem that way because Powell destabilized it yesterday. But we think that's going to stabilize the market. And we also think that the next inflections, maybe not the very next one, but some of them will be positive on the tariff war. There's going to be some agreements. Bessent is a dove. He's in charge of that. So we actually have a 5 to 6,000 range on the S&P for the first half of the year. So that implies that above 5,500, you would fade the market, but like yesterday, the market went to 5,200, you would buy it. And then our year-end target's 6,600, which is pretty high from here, but not where we started the year, just 22 times next year's earnings. It assumes the tax bill passes and there's no increase in taxes on corporations. We became less bullish about the tax bill because this is a pretty populist administration, obviously. So we're more constructive than we were a couple weeks ago, and we were appropriately. It's not a bad rule of thumb to be cautious when we're not in earnings season and be more bullish when we are. And you'll probably see on Monday, we don't know for sure, but might be other news, but Netflix beat earnings slightly. So that's positive for tech stocks. So Monday could be okay. We talked about bonds. We're pretty neutral on oil. So we reduced our target to $70, but with the 60 to 80 range. And I wouldn't recommend trading oil. It's really hard. We have nearly perfect ranges. So it did bounce around 60, but we don't trade it in our speculative hedge fund. It's just really hard to trade. So I wouldn't try to trade it, but it's good for macro because, probably oil will come up a little bit, which will be less deflationary, but it's still going to be down off of it where it started the year. This is what is slowing the housing market. The cost of buying is 88% higher than renting. So you're seeing a pretty sluggish housing market, but not crashing. And it's helped that the bond market has really cut rates for the Fed. So we were at 480 earlier in the year. Now we're closer to 430. So 30-year mortgage is below 7, which is critical. So we think housing will be okay, but slowing, continuing to be slow. Maybe not slowing, but continue to be slow. This is something, if you want one key to economic forecasting, use what's called the money supply or monetary base. And we actually keep track of the global monetary base because sometimes like Europe shrank it a lot and global rates rose a lot. And so if you look at this chart carefully, you can see like if you invested when it was skyrocketing in 21, you would have printed money late 20 and 21. And then when it rolled over at the end of 21, it would have been a good time to be out of the market. And now it's a little bit gradual because the US is behind the curve, but other countries are cutting rates. And to cut rates, you have to increase the money supply. If anybody cares about that, I can explain that more. Most people don't understand that. But so look at money supply.
Yeah, I'd love to hear you explain that actually.
Okay. Well, and this is like the master course. So if it's a little bit confusing, that's okay. So if you understand this, you'll be in the top 0.001% of investors, not even the public. So what people don't recognize is to set Fed funds, the New York Fed has to constantly intervene in the Fed funds market, which is the overnight repo market with the big investment banks and money center banks rather. And so when the way to gauge whether the Fed is tight or not, like the Fed, they're highly incompetent. So some people say, oh, we're not tight at the Fed, which is sort of remarkable. But if you look, it comes out every week. It's called H.4.1 on the Federal Reserve. It's pretty easy to find, actually. You can see the monetary base and see how it changed. And that's the critical element. So for the Fed to keep rates as high as they are now, and we had some good charts on the prior presentation that showed, in effect, they're high by looking at the yield curve. But you can also look and see what did it take to keep rates at 433? Well, the answer is it required the Fed to shrink the money supply. So that's bank reserves plus currency by an annualized rate of 2% year over year. So that normally they grow it at 5, which is nominal GDP growth. That keeps inflation, close to the 2%. Well, the arbitrary 2% target should be 2 to 3. And so it's that growth rate, or conversely, it's easier to see this. If you wonder, the Fed lowered rates to 0, right, during the pandemic, and you could say, oh, well, is that loose monetary policy or tight? I mean, it's kind of obvious it's loose, but to do that, they had to increase the money supply 70%, which has never happened before, and created the double-digit inflation that we ended up with. So you want to be invested. So the economy's kind of sluggish now. It's because the Fed is holding back on growing money supply. Prices are dropping. Demand is dropping. So you want to we think that they're going to cut, then they'll have to increase the money supply, and that'll add liquidity to the stock market, and most certainly create a pretty dramatic rally. The rest of the world is rallying, and that's probably a lot of that to do with that growth in the monetary base. It's mostly overseas, or all overseas, because we're shrinking. So you can also use it as a guide to allocate capital between countries. So you want to be in countries where the money supply is growing. But now just focusing, so we're not going to talk about equity income strategies. Somebody's interested in that, we have a different presentation and we can talk to you about it. But this is kind of what I call the money slide, or in other words, the most important slide. And so this, as I was teasing before, are 7 different asset classes that you can invest in on the fixed income side. And the way we have this organized is at the top, I guess roughly organized. At the top is what has the most interest rate risk. So that's beta is a fancy word for correlation. So treasuries, I don't know if you can see, oh, there we go. I guess you might be able to see his pointer. Treasuries are at the top. Of course, they have a one-to-one correlation with treasuries. So they're very interest rate sensitive. Munis, oops, sorry, clicking changes the slide. Munis are pretty similar to treasuries, not quite as interest rate sensitive. I'd say actually they're a little bit higher than this 0.52. But then the second column, this column over here is important because this is the risk or correlation you have to the S&P. So if you want to build a defensive portfolio, you should definitely have some of these categories, the first 3 categories, where treasuries, munis, and corporate investment grade corporate bonds have like almost de minimis correlation to stock market. And in normal markets, those asset classes will go up when stock markets go down. The counterpoint, though, is if rates go up, those 3 funds will go down, and probably the rest, these other 4 funds, which have lower correlation to bonds. This preferred, things have been a little bit screwed up because of the pandemic, but in a normal market, preferreds aren't as correlated as this implies, but they are correlated to the stock market about 50%, 0.49. High yield bonds, same thing. This is a more accurate, this is what I would say preferreds really are, even if the data shows higher for preferreds, but high yield bonds have a little bit of correlation, 0.47 to bonds, 0.42 to the stock market. Senior loans is a good asset class, not correlated to much, get lower yields like around 4 or 5. And convertible bonds don't really get you much because they really just like owning equities and you don't get a lot of income. But what's great about the more risky classes, preferreds, high yield, and senior loans, is you get substantial income. Like BNDS is our bond fund. There's a fund BND that only yields 3.8, so not very good income and a ton of interest rate risk. So it's sort of a graphic example. You can get BND, take a ton of interest rate risk, de minimis or even negative stock market risk, or you can get BNDS and take a little bit of interest rate risk, a little bit of stock market risk, but a lot more income because it yields over 8. BNDS yields under 4. So these are the asset class we do recommend, maybe except for convertible bonds, because that almost really should be in your equity portfolio. but you have like 5 to 10% of your portfolio in these sectors, after you allocate between equities and fixed income. Unless you're really, really conservative and really desperate for income, it's always good to have a substantial amount of equities, because equities will normally have higher total returns than fixed income. But obviously, for that return, you have a higher risk and its correlation to the stock market. So that's a good slide to focus on in terms of building your portfolio, what asset classes are available. Then we have 2 funds that are in the preferred category, PFFA and PFFR, and then BNDS is in the high yield category. But we want to make sure that everybody builds a diversified portfolio, so we're not recommending your fixed income portfolio is like 40% PFFA. PFFA is 75% of my IRA, but of course I manage it. We are true believers in preferreds, but we don't recommend that allocation. One thing that people don't appreciate, particularly about preferreds, is they'll say, oh, these are, a lot of them don't even have any maturities, so they must have infinite interest rate risk. But what people don't recognize is that when you have a big coupon, it lowers your sensitivity to interest rates. And so that's why BNDS has lower sensitivity than BND, because it has a much higher coupon at 8%. And so there's something called duration, which is a fancy way of saying interest rate sensitivity. So a 10% coupon, even a preferred, has an effective duration of only 9 years. So it's like a security that matures, 0 coupon treasury security, 7% coupon, 12.5, but a 5% coupon is 17. And so just recognizing, say, oh, well, this is a great security and it's a great company and it's great credit and it's a 5% yield, but you're taking a lot more interest rate risk. So it's really, we're just quantifying what I already asserted, which is the higher quality bonds have more interest rate sensitivity. We do think preferreds are very attractive. They have only a 0.59% default rate over the last 30 years, which is higher than investment grade bonds, but about 20% of high yield bonds. Just to be fair, the recoveries on high yield bond defaults are usually about 40–50%, whereas preferreds can be 0 except for utilities. So if you correct for that, we still have better risk-adjusted default rates, and the yields are pretty similar. So good way to add yield. High yield bonds are less volatile though. So a lot of people are buying our fund BNDS because you get high income with not taking a lot of volatility risk. It's about half as much as preferred stock funds. This is something not too relevant right now, but big advantage of active management is that you don't want to buy preferreds trading about 25 if they're listed. So you might look and bear and say, oh, this looks great. It's $26. It's yielding 9%. But the company can call it at any time and you lose $1 because it's callable at 25. So we're monitoring that with PFFA and PFFR. We have smart data that kicks it out of the index when it's above par. So talking more about high yield bonds, they're less volatile than equities, but have much better income. In terms of BNDS, we try to find mispriced securities. We do our own ratings, don't usually agree with the rating agencies, and try to find the most attractive income relative to ratings or default risk. Highly diversified portfolio, about 70 credits. And we do construct the portfolio to have more liquidity than the average high yield bonds. So we have a lot of listed bonds. I have some small amount of listed preferreds as well. So this is just a chart that shows the return, annualized return and the volatility. So it's return to volatility. You can see that high yield bonds have the best ratio there. Also return to income as well. The current yield is very attractive relative to volatility. So if you want a way to get almost equity-like returns like 7, 8, 9, way lower volatilities and great income. High yield bonds are good alternative. And this is Sharpe ratio is a technical way of saying that volatility to return. So this is like a hypothetical portfolio with half high yield bonds, half S&P. So you can get a better Sharpe ratio by mixing in high yield bonds relative to treasuries and munis and investment grade. Partly because the yields are way better, of course. Let's talk just a little more about BNDES. It's monthly pay, 8% yield, a little bit over 8. We do manage it actively. So if somebody trades above par, we'll sell it. If there's a problem credit, we'll sell it. We'll manage the interest rate risk. And we do, as I already mentioned, have a lot of listed bonds, which we think are more stable, lower trading costs. And we do mix in just less than 20% preferreds, which often are attractive and a good way to add income. So you can see that actually high yield bonds do offer the highest yield relative to other fixed income, not surprisingly. You're taking more risk. And it's similar to preferred stocks. So active management has beaten on a Sharpe ratio basis, so it's volatility to return. Passive high yield, and that fixed income, you really should have active management. You have to manage call risk, interest rate, default risk. None of those risks occur with equity. You can just do cap weighted and it's probably going to be fine. Not true of fixed income. You can see this, just the chart, what I already mentioning is that we have a very high percentage of listed securities, so more efficient from trading perspective, more liquid. It's the top holdings. A lot of these companies are ones you might know, particularly if you follow MLPs. There's a couple of MLPs in there, but good credits with good yields. You can look at these details. This has some of the return data. So you should always look at that relative to anything I say about it. And then we're going to talk about preferreds, probably wrap up in a few minutes. So please ask questions, think of some questions while I'm finishing up here. So we talked a little bit about preferreds. They do have lower default rate, as we mentioned. They typically yield more than high yield bonds, but yet the credits, the senior credit or the credit of the entity is similar or even higher than high yield bonds. So lower defaults and good yields. And you also get attractive taxation. PFFA has about a 22% effective tax rate. So we think it's a great asset class. The only thing to be aware, and we saw it recently, is they are more volatile than high yield. It seems like, oh, the world's coming to an end, but it's just retail investors panicking and selling this great asset class. So you can see that you have more, less default risk, but still strong credit quality. And so, as we saw before, the default risk is lower. We have higher market cap with PFFA, more BBB rated credits, and more public companies, because public companies generally are better credits than private companies, because public companies care about their credit rating. It's just a good chart. It shows that where preferred equity comes in terms of fixed income capital, it's below, preferred is below everything else, but it's ahead of equity. So that creates lower volatility than equities. And the yields on preferreds are superior to these higher level securities that, if there is a bankruptcy, they get paid first. So that's the key distinction there. But, without risk, there's no return. So you get higher yields with preferreds. So you do get tax advantage distributions with preferreds. And the reason for that is they're preferred stocks. And stocks get the benefit of excess depreciation. REITs get 199A deductions. You capture that with preferreds. Bonds are just fully taxable, so you don't get that. So it's important to keep that in mind, what your after-tax return is, and preferreds are attractive even relative to muni bonds, which are typically not taxed. They do pay monthly. It's well over 9%. It's critical to have active management. And we do what really has caused PFFA to dramatically outperform is we just picked better preferreds, better quality credits with good yields. And we do trade. When they trade above par, we'll sell them, we'll buy them below par, adds income. We've increased the dividend for 3 years. We have a better Sharpe ratio than PFF, which is the big index fund. Sharpe ratio, again, being a return relative to volatility. One thing to keep in mind with the passive funds, they're huge, 15 billion PFF. They rebalance monthly, and they tend to distort the market. So this is just a chart of when a preferred got added to the index on a surprise basis. It traded to $34, even though it's callable par. And of course, the index fund was buying it, and then it returned to its normal value, which is a little bit above par, but not that much. So you don't really want to be in those index funds that have to rebalance monthly and cost investors money. And these are just some of our bigger holdings. Energy Transfer, probably a lot of you know. Flagstar's now a good credit. BANC's also a very good credit. So a lot of recognizable names. We do have a lot of financials now. They became very attractive. We did not going into 22, so that helped our performance. We try to be diversified by, or we are diversified by sector. And this is just the boilerplate return data. So I've asserted that we've outperformed, but you can look at that up in detail here. And we should. So I guess hopefully there's some questions, Todd, or maybe you can make some up if there are no questions.
Actually, Jay, we do have some questions. And one question was regarding PFFA. Are asking if the preferreds in PFFA are all investment grade?
You know, they're not all investment grade. Their issuers are mostly investment grade, but keep in mind the rating agencies, we think fallaciously, downgrade preferreds like 3 notches. So Energy Transfer is BBB+, so a very strong investment grade credit. But Energy Transfer Preferred is BB+, which is a strong non-investment grade credit. So that's kind of where we want to be. Very strong BBs, weak BBB minuses, low default risk, but very high income. So that's kind of the sweet spot. If you only buy investment grade preferreds, it's sort of like just buying investment grade bonds, where you get a lot of interest rate risk and no income. Or low income, not no income.
Got you. Okay, another question we received was on AMZA, which I believe is your MLP fund.
Right.
And the question was asking if he doesn't understand how AMZA can issue a 1099. He thought that doesn't a fund have to have less than 25% of the fund in MLPs in order to issue a 1099? So I guess it's a tax related question.
Yeah, it's a great question. So to not issue a 1099, you have to have one of two characteristics. You can be what's called a RIC, so registered investment company. And that's what almost every mutual fund and ETF is. But then we're a corporation, and we bear the cost of this. We file a super complicated corporate income return. And so we take all those K1s in, Price Waterhouse, God bless them. files this massive return, charges us a lot of money, which is built into our fee, and then you get a 1099. So you can only get 1099s from corporations and RICs. We're 80% MLPs, we're a corporation, so it's a tax efficient way to access MLPs. You can put it in your IRA. You don't get recapture, something called recapture charged when you sell it. So it's in general a better tax structure relative to owning them directly.
Right, yeah. Good for a vehicle for a good investment for a tax deferred account. Can you you may have referenced this phrase. One of the attendees asked, please define the phrase paper holdings. I don't know if
Uh,
that came from your presentation or not.
Paper holdings?
That's what the question was. I didn't catch that if you mentioned that during the presentation.
I
So
hope I didn't say that.
they may have misunderstood the phrase or thought it was something else, but
Yeah, so I don't know what that would mean, so I apologize. If I
okay.
didn't articulate, I apologize.
Okay. Uh, I know your presentation is focused on fixed income, but one of the attendees asked just in terms of, because you do run equities as well, talk about asset allocation between stocks and bonds in the current environment. Which asset class do you favor and why?
Well, we're bullish on both stock market and the bond market, although admittedly it's pretty stressful to be a stock investor right now.
Mm-hmm.
So it's really more what each investor's risk tolerance level is. So if it's very low, then you could be 60, 70, 80% in bonds and preferreds and, should have some investment grade as well. Because then you get your whole portfolio has a lot less equity exposure to the stock market. But for instance, my mother-in-law is about as conservative as you can be, but I keep her about 50-50 because she actually has a lot of income from defined benefit plans, so she doesn't really need it. So there's really no reason to be, I just keep it pretty conservative because she's like a war baby and gets nervous and, always asks if we should sell everything when, bad things happen, which doesn't usually work unless you're a hedge fund manager because it's hard to get back in. But so it's really driven by how much risk you're willing to tolerate, how much income you want, and what's your investment horizon. If you're going to retire in 60 years, you could be in 10% bonds, 90% equities. If you're already retired and you want to sleep at night and you want to cover most of your expenses, you could be, 60, 70% bonds, lower volatility. So it's really individual objectives and financial situation that drives that allocation. But you should arrive at something you're comfortable with. But then make sure you're diversified. Like I said, don't be all in PFFA or BNDS or any other fund for that matter.
Right. Okay. Good. One question is, and I've heard other fixed income managers and analysts refer to this, that they believe that uh, high yield bonds are a higher quality asset class than they have been in previous cycles, market cycles. Do you agree with that? Do you concur with that?
I think what we do, I think most companies, like if you look at energy companies, they were a huge problem in the last down cycle, but
Mhm.
they have way less leverage than they ever had in the past. Like they're 1 or 2 times levered, like pure energy companies, pipeline companies, way less leverage. So I think that most companies, even private companies, have become more full cycle in their capital structure. So in other words, have more equity and less debt. So I do agree with that. And then of course, we believe the ones we pick, do have very low default risk. That remains to be seen, but that's what we're looking for.
Gotcha. A macro question. Assuming we know, obviously, the Trump versus Powell, which you alluded to right now, and Powell, I think his term is up next year. Anyway, and regardless of what happens with that, um, do you have any particular characteristics you want to see in a future Fed chair that perhaps are not currently being met?
Yeah, so we would like to see it, Fed chair, to recognize the current, not just Powell or any member of the Fed being flawed, but that their framework is flawed. So they have this arbitrary 2% target, way too low, caused the great financial crisis. They should have a more flexible target, 2 to 3%. They should not just look at PC core, they should look at all inflation measures. So if PPI is skyrocketing, that's a problem. Fed ignored that in early 2021. They should use a fair amount of judgment too, like Greenspan used to. Should have an employment target, minimum or maximum unemployment. And you should also have a base target, a monetary base or money supply. Shouldn't have like now negative money supply growth, and you shouldn't have 70%. It should be 5 most of the time, 3 every once in a while, 7 every once in a while, but not 70 and -2. So it's a problem with the current Fed, way too volatile. They ignore the money supply. They're all what's called Keynesians. So Powell doesn't think the money supply matters. That's a huge problem. It's like the Pope not believing in Jesus. So hopefully somebody who cares about money supply, understands it's important, understand that inflation comes from excessive monetary growth. And by the way, that was perfectly proven during this cycle. The Fed, they went up to 70, but then they came down to 60 because they tightened, obviously. And nominal GDP grew at 38, and Milton Friedman would be dancing in the streets because his theory worked perfectly. Inflation was residual. And that's his thesis, that inflation comes from excessive monetary growth. So in other words, growth in the money supply above nominal GDP. Worked perfectly during the pandemic.
Okay. Just as a follow-up question to that, this doesn't put you on the spot. Are there any particular candidates out there that you think would make good Fed chair if you're able to name names or willing to name names?
I'm a little bit concerned about Warsh because he's what I would call like a swamp dweller. So he was a member of the Fed during the great financial crisis. So he implicitly believed in this super arbitrary, way too low 2% target. He was arguing for tighter monetary policy during the financial crisis. And so there's no indication of what I just said before, which is that he would reform the Fed. So he's probably a true believer in all the Fed's mythology about inflation that has served them terribly over this cycle. So I'm concerned about him. Scott Bessent would potentially be good. I don't really know what his monetary philosophy is. And I would just pick somebody who's effectively a monetarist. Jeremy Siegel's getting a little bit older, but he's a monetarist. There's just somebody who understands this very basic concept that money supply matters.
Kind of like Judy Shelton myself, but I don't know. Yeah. Okay, that's helpful to know because we may be presented with that possibility of a change sometime in the not too distant future. Okay, I think let me double check to see if we have any other questions we didn't get. Let's see. I think. Oh, excuse me. Um, a couple of in terms of positioning in taxable versus tax deferred accounts. One viewer asked about compared to stocks, is it better generally to put bonds in a Roth rather than a 401 than a conventional 401k?
Okay, so I need to review all my tax, characteristics of individuals. But so a Roth IRA means you have to, you don't pay tax when you take it out, right? And then with a
Right.
regular IRA, you do. Okay, just so that was remedial for me. So I mean, simpler question is, like if you wanted to do BNDS and PFFA, for instance, or preferreds and bonds, PFFA would be superior to BNDS in a taxable account. So because its effective tax rate's well below the normal rate, and BNDS would be better in an IRA. And I guess using that criteria, a Roth IRA is more tax sheltered. So I guess in theory, it would be, better to have BNDS in a Roth versus a regular IRA.
Okay. Another question we got here is how would you compare the volatility of BNDS to a typical floating rate high yield bond fund? Is there much of a significant difference there?
The main difference there, so that would be like a senior secured loan fund. So you're going to have lower yields with those. You're going to have basically no interest rate risk and a little bit, the market, particularly in extreme market conditions, probably about half as much volatility as high yield bonds. So if you just want something super low volatility but lower yields, senior floating rate bond funds are attractive. But it's a little bit similar to just rolling over CDs. I mean, you get more than that, but you don't get a ton. You probably get a yield of like, I could even look it up. BKKLN, I think, is one of these funds. Let me just look up what their yield is.
Okay.
But you usually get, without risk, there's no return. And so, oops, sorry. Let's see if I can do this quickly. So one big ETF has, pretty low indicated yield. It's like in the 6 range. So you get a little bit lower yields with these floating rate type securities. And let me just quickly look and see how they've done relative in this little downturn we have going here, or not so little downturn. They did get pretty smacked. Well, not that bad. So it went down about 5% at the lows. So not terrible, but actually more like, yeah, it was at 21 and now it went to 20 and now it's bouncing back. So it's a 1 over, yeah, about 5%. So a little bit less than high yield bonds and a little bit lower yields.
Okay. Thank you. Another attendee asked, does PFFA invest in REIT preferreds? And would like to know theoretically, if that is the case, what happens with preferreds when two REITs merge? Does the acquiring REIT honor all covenants of the acquired preferred?
Yes, normally they definitely would. And they also, sometimes they're puttable by the investor and sometimes they'll call them. So it's normally a positive event. Even sometimes when there's a buyout, so it's not a public company, there's covenants in the preferreds that if there's a change of control, they have to take the preferreds out. So they do honor the covenants. They almost always keep them listed. And in many cases, they're call them, which if they're trading below par is a huge win. So we've had a number of securities that where even in a buyout, the preferreds were trading at 20 and then it got called at 25. So it was a huge windfall to have a buyout. Not always, but most cases it's positive.
Okay. Someone asked if they only owned one or two bond funds in order to simplify their portfolio. Which bond funds would you recommend? And understandably, probably some from your family.
Yeah, so yeah, I mean it's kind of obvious that, so just to use real numbers, let's say you're 50% bonds, it would be perfectly reasonable to be 5% to 10% in either PFFR if you want pure REITs with no leverage, or PFFA if you want active management. And when I say percent, I mean of the whole portfolio. So up to 20% of your fixed income could be in preferreds, up to 20% of your fixed income could be high yield bonds like BNDS. But 20% of your fixed income, if it's 50-50, is 5 to 10. And 5 to 10 is a good rule for almost any ETF or any mutual fund. Just, you never know and what asset class might do better than others. So we do, if you look at my holdings, I own a ton of PFFA and I'm increasing BNDS and I do like the income. particularly in my IRA. And then I know I don't need the money right now, but I'm reinvesting my dividends, getting more income. We're trying to grow the dividends, at least with PFFA. Just kind of a virtuous cycle where you get more securities, more income, and you take that income and buy more securities. It's kind of like a cookie monster eating the capital markets, and all goes into your IRA.
Okay. Given the direction of the dollar too, could you talk about the factoring that in and other considerations? Could you talk about your outlook for international versus domestic bonds?
Mhm. Well, I mean, we are optimistic about US bonds, and US bonds have the highest yields in the world, or close to them at least,
Wow.
Mexico or something, but developed countries. And so we're bullish on US bonds, even treasury bonds. So we probably would stick to that. It is, as I indicated before, you're getting that money supply increase overseas. So if we had this call at the beginning of the year, this would be better advice than now. But it's reasonable for the first time in like 4 years to have Europe outperform the US. Places where monetary policy is way looser than our incompetent Fed is good for equities. I would just be a little bit cautious about Europe. I mean, they are socialists and they have right now. So you might want to pick individual stocks, or like defense stocks are doing well, but they also run up a lot. So like I said, it'd be better. It might have been better advice like 4 months ago.
Okay. Another uh, macro question is when you look at these tariff levels, particularly, with China, 145%, that could be starting to destroy supply lines. And there's some people concerned about, the U.S. because of these excessively high numbers that are being thrown around. Do you have any additional comments on that?
Well, we do think that it was highly disconcerting when what we call the chart of death was unveiled, the table with all the kind of ridiculous tariff rates,
Mm-hmm.
because then everything is expensive. But if China is 150% and Europe's 10 and maybe Japan's 0 because there's a deal with them, maybe Vietnam's 0, then companies can arbitrage. And probably what will happen is China will ship their goods to everywhere but the US. And then that'll displace other goods that then get shipped to the US. So there's a lot of arbitrage activity, which, to validate your point, would not have been available if rates were super high all over the world. But if they're
Mm-hmm.
reasonable, like 5 to 10% in most parts of the world, then the securities can flow to the appropriate spot, and we shouldn't have the big dislocations that could have occurred if the tariffs were not delayed 90 days.
Got you. One other attendee asked, what's the worst case scenario for bonds?
Well, if we had a super deep recession, which is our models would say is kind of 0%. So then you could have a spike in defaults and, a decline in the price, probably not as much as equities. They get dragged down by equity. So it's really that equity risk. And we saw it in the last 2 or 3 weeks, like high yield bonds are down like 5 to 10%. So it's really deep recession and crashing stock market. More resilient to reasonable increases in interest rates, not to 8 or something, but that's virtually impossible in today's market to get much above 5.
Got you. Got you. Okay. Well, I think we've actually gotten to the end of our questions. Um, and um, um, and I'd like to um, thank Jay Hatfield for an excellent and very insightful presentation. Again, I'd like to thank Craig Starr at InfraCap for helping arrange this presentation for Jay to be here today. And finally, I'd like to thank also able webmaster John Wong and Gilbert Ho for co-presenting, and for the audience for some excellent questions today. And so we'll be in touch on our next presentation, which again is normally third Thursday of each month. And we'll so watch for emails from us as well as on our site, on the AAII site for for the income and SIG group. And cash flow SIG group, and also again any presentations we'll actually post on the uh, Portland PDX website for AAII, or links will show there that will take you to the right place where you can view the presentation and take a look at that after we go through compliance. So thank you again, Jay and Craig, and for everyone for attending today. And we hope to see you soon. And thank you very much.
Thanks, Todd. Great to be on.
Thank you.